David Hunter, the Contrarian. He works with Contrarian Macro Advisors, and he's here to share his take on why he thinks that we are pretty much in for a melt up that's going to lead to a global bust. Right? We've still got a ways to go with equities in this rally that we've seen. And I want to break it all down because you have been one of my most popular macro guests, David. It's great to see you.
Yeah. Hi, Natalie. It's great to see you.
Well, let's go ahead and start with maybe a zoom out version of what's your macro take on the economy and on markets right now?
Sure. Yeah, I think, the economy is still surprisingly intact. I have always talked about a have and have not economy. Some people call it a K-shaped economy. And I think that's still the issue is that, half the population doesn't feel like we're in a booming economy at all, probably more than half. And frankly, we are seeing signs that things are moving towards a recession. We're not there yet, I don't think. I know there are a few people out there saying that, based on some numbers, you could argue we're in recession now, but I think we're moving that way. The economy's slowing, but amazingly, it's still intact. You could have made these same comments a year ago, and it's still kind of pushing along. But I do think as we get closer to the end of this year, we could be in a recession, and if not, very close. Manufacturing, because of the reshoring and all that's going on with AI, that's really holding the economy up, and that side of things looks really good, as you might see in some of the industrial stocks, et cetera. But it's the other, the consumer, half the consumer really is struggling. Amazingly, consumption's still fine, but you are seeing signs they're having to pull more out of savings to keep their shop till you drop spending going, and that's obviously can't be sustained. So jobs are slowing, but every time you think they're really going to start giving you bad numbers, they kind of pull themselves back up. So we're just kind of, I don't want to say steady as we go, but we're skating along here in positive territory on the economy side. The markets, I am as bullish as ever. I do think it comes to an end, maybe before the end of this year, but right now, my numbers are, if you go to my targets, you're still looking at more than 30% upside in all the indexes, all the four indexes I target. So, Dow, I just raised my target in my July letter to 10,000. I had been at I'm sorry, not 10,000, 70,000. I had been at 67,000. My S&P number is 10,000, and I didn't raise that one this time, but I'm at 10 there. I'd raised it in early June. I'm at 36,000 on the NASDAQ and raised that in early June, and I'm at 4,000 on the Russell. And, for a long time, I got beat up for my Russell bullishness because it lagged the others, but it has certainly caught up this year, and I think still has good upside ahead. So what I see out there is really, I think the next few months are going to be really strong. Whether this takes, I get people on X constantly wanting me to tell them what time it's going to top, and I say it can happen very quickly because I think we're in a parabolic. If you look at the monthlies on the charts, you can still argue, in spite of a June consolidation, you can still argue that it looks very vertical here and that it's going to just get steeper from here. So if that's the case, if we don't go through a long drawn out consolidation, you can get to those numbers, believe it or not, within a few months. But if it takes longer, it takes longer.
Well, and I think you've mentioned that in sort of these late stages of parabolic moves, the sort of melt ups, there's cash on the sidelines waiting, thinking that, no, it can't go higher. It can't go higher. And then all of a sudden it all piles in because it's like, wait, I don't want to miss out on the continued rally. And at that point is when you sort of go off the cliff, right?
Yeah, psychology plays a big role in markets. And I'm a contrarian, have been for 50 plus years for a reason. It's because at tops, people are most bullish, and at bottoms, people are most bearish. In between, you're kind of in the middle of that. But But so I think at the top will be everybody will be all in, retail and institutional. Will be talking about this thing having years still to run, um, and they'll have there'll be a narrative out there that's very convincing. Institutions will be spewing it as well, not for any reason other than they believe it. But that's how psychology works. There's fundamentals out there. I mean, the earnings this year have been stupendous and look like they're going to be strong into next year. So there's fundamental reason to be bullish. But technically, things look great. I mean, still, we're coming, as I say, this is, as of August of this year, we'll be 44 years into what I call a secular bull market that started back in August of 1982. So we're late in the game. This thing can't go on forever. Valuations are high in lots of stocks, but not in all stocks. But fundamentals are just so good. You don't end bull markets on valuation. You end it when, looking ahead, there's something fundamental that's going to change. So at this point, I mean, I am very bullish, but also know that there's another side of the mountain coming.
Well, let's talk a little bit more about that because I think the first time you came on this show was around 2021 or two, and you were predicting that we were going to have the melt up at that point. And we're sort of good at kicking the can down the road, right? So I'm sure folks that follow you are like, wait, what is it going to happen? Is it happening? It's delayed. Can you talk about what will actually cause this turnaround? Because again, you keep consistently raising these targets, and it's like, how much longer can this actually go on?
Yeah, I mean that's as John Maynard Keynes said. I'll paraphrase because I don't remember the exact quote, but it's when the facts change, I change with them. What do you do, dear sir? It's obviously I haven't changed my bullish view all the way through, but people get upset because I've been talking about a bust for 5 or 6 years, and they go, "Yeah, well, you called a bust 6 years ago. You've been wrong." And I said, "No, I've been bullish the whole time. It's the bust follows the end of the bull market. What will cause it? Obviously, nobody knows for sure, but it's usually um, some sort of misstep in Fed policy. So they might tighten when they should be easing, or they may not ease enough, or they might not recognize the need for more liquidity. Obviously, if you get a very bad inflation story, and not for a month or two, but if that were to continue, if things went wrong in Iran and oil went to 150, those kind of things can really turn the economy down, and the markets would react ahead of that, or at least react pretty quickly to signs that that's going to come. Um, as I say, the reason I'm calling for something bigger than just a normal recession, something that I call a global bust, is because of leverage. We have far more leverage today in the system than we had in 2008-9, and that was off the charts then. So, 2008-9 happened because of the leverage, or was far worse than it would have been otherwise because of leverage. And this time we're far beyond the leverage we had then. And I define leverage as the debt obviously is leverage on the financial system, on the economy, and derivatives are leverage on the markets. And we've been, really since the 80s, been creating all these derivative products that are now mainstream in retail as well as institutional, and it's that leverage both on the debt side and both on the credit side and on the equity side. There's just all kinds of leverage in derivatives, so that when this thing does turn down, that leverage, both debt and derivatives, exacerbates the downturn. So what kind of enhances on the upside, options and margin, if you're right, that can really give you the chance to make more money. But when things turn down, that leverage really exacerbates the downturn. So I think that's the biggest reason for something worse than just a plain ordinary recession that we have every number of years, because things go to excess in the economy and in credit markets, and they just get corrected.
What do you say to investors listening to this who say, no, we've outlawed recessions. We
Mm-hmm.
can't have a bust because they're just going to come in and print their way out of it like they always do. And the markets have seemed to come to a consensus that they'll be taken care of.
Yeah, so I've been a follower of the Fed since I entered this business in 1973, the one thing I can say with assurity is that um, Fed Feds lag, policy lags, so it's almost guaranteed that they're at one time or another going to misstep, and you know that plus the fact that when the reason you get to ends of cycles is because of excesses and imbalances. In 2008-9, it was subprime, among other things. Now it might be private credit. Certainly, private equity is very leveraged. Um, People get over their skis in terms of bullishness and exaggerate what they kind of extrapolate what's happening now and think it can go on forever. Ultimately, um, I think 2008-9 almost guarantees that the Fed is not going to do that this time, at least on a timely basis, because you heard Jay Powell say it several years in his reign that we're not going to make that mistake again. We're not going back to QE infinity. We're not going to see zero interest rate policy ever again. And Kevin Warsh, I think, has put an exclamation point on that same thing of saying, he's a monetarist, and certainly of that bent, and knows that money causes inflation. You hear him talking ever since he became chair that his first mandate is to control inflation, to get interest rates, that interest rates will follow inflation down, and that the Fed's mandate, first and foremost, is to make sure that inflation doesn't break out. So he's going to be focused on that, which is we're not going to we're not going to print money ad infinitum, and create that inflation I know would come following that. So what that means is because of 2008-9, they're fighting the last war. They're basically, when things start turning sour, they're going to be reluctant to put money in, and they're gonna put some in, but they're going to be very gradual and reluctant. And if I'm right that because of leverage we're going to have something bigger than normal, it's a real conflict that the policy is fighting. Doesn't want to go back and make that mistake again, and yet the policy that's demanded is actually more, not less. So you're going to have that problem somewhere down the road. Timing is obviously the question. I think it's next year, but can they kick the can down the road further? It's possible, but we are seeing more excesses and imbalances starting to build, and troubling signs in credit, delinquencies on debt. Those kind of things are the things that once they go over a certain threshold, you're in trouble.